Thank you very much, Lloyd. And I'm delighted to be here. And for those of you who are worried about opening up with an economist on a Friday morning, there's plenty of coffee in the back, and I won't be offended if you go get some. You might need to bring me a cup at some point as we go through this. So I want to talk about global crude and gas markets. And it all affects everybody here. And so where we are today in the global crude market, where we're going, the structure, what's been behind the latest price decline. When I was here a couple of years ago, what was behind the latest price increase, now what's behind the decline, what's going on with natural gas, and then we're going to talk about U.S. energy security. And we've been talking about energy independence, energy transportation. These things are all tied together. And what we see in the political arena, what we see in the policy arena is a lot of individual fiefdoms and a lot of protectorates and a lot of interest and not much of a systematic approach to energy policy, except it seems in Wyoming. So let's see, why do I want to worry about this? Well, we want to talk about misconceptions and where we are today. And so why would we worry about crude oil at all? Well, first of all, nothing, absolutely nothing about the crude oil market indicates that it's a free market. 82% of the world crude reserves are held by sovereign nations that are not the United States. During the Great Recession of 2008, crude prices rose and then plummeted. Remember, they hit 147 at WTI. And then by December of 2008, it was trading for $32.80 a barrel. More importantly, let's see if I can get this, whoops. Rand estimates that there's at least an 8% probability, these are the war games guys, right? The fellows that John Nash worked with, that Andrew Marshall worked with, the folks who do the strategic thinking in the Pentagon, that there's at least an 8% probability of a major supply interruption over the next decade. Various hostile countries have at one time or another threatened to block the Strait of Hormuz. Through that goes 18.5 million barrels of oil a day. Iran fired on a ship in the Strait last month. The Chinese conducted joint naval exercises with Iran in the Strait in September. This is a real issue. In 2006, terrorists were repelled trying to blow up a major Saudi terminal. That's something we actually know about because it was very large. For decades, the U.S. energy policy has been one of neglect, or we've actually had policies that directly conflict with our national interest. Everybody remembers the Arab oil embargo of 1974, but what they don't remember is that the oil imports continued to flow into the U.S. We never missed a lick. What caused the long lines at the gasoline stations? Any ideas? This is trying to engage you. Anyone can raise a hand at this point. This is the way it works in class. And no hands go up in class either. But some of us were here in '74. And so the reason we had that was the domestic policies. We had wage and price controls. Nixon had frozen the price of gasoline at the pump, and refiners were still having to buy crude oil at a much higher price. Now, Jim's here from California. He remembers, of course, what happened when the legislature did that to PG&E, and they could only sell electricity at 9 cents a kilowatt hour, but wound up paying equivalent of 30 or 35 cents a kilowatt hour for the supply. That was what we in economics call unsustainable. And so in 1974-75, we had refineries that just basically shut down. They withheld product from the market. That's why we had the long lines. Then we put in the windfall profits tax. And everybody says, oh gosh, the US has peak oil problems, we're not able to produce anything. Well, no, we changed the rules. We had a big expropriation of profits from the producers. And the big oil companies, they went offshore. They said, well, hell, we can get knocked over by some potentate in another country. We don't have to hang around and take this here in the US. And so with crude oil prices fixed, with windfall profits on new wells, the rates of return just went away, and so did exploration. And so there are all sorts of arguments, and we've seen this. You know, the government of the United States, under the present administration, has withdrawn oil lands from entry in order to conserve this asset. And that was, of course, written in 1931. Very topical. Whereas one of my professors said, the questions on the economics of energy midterm from 30 years ago are the same questions that'll be on the midterm in 3 weeks. So the world oil market is one market, as this wonderful diagram by Professor Nordhaus points out. It's a bathtub. You know, the economist law of one price dictates that apart from oil transportation cost and grade differentiation, and he's done all of the heavy lifting with econometrics behind this, crude oil, light, sweet, heavy, sour, that price is the same across the world. Oil is the only global commodity priced exclusively in US dollars. Differences in price between the Bakken, the Cushion, Gulf Coast, Brent, Saudi Arabia, all made up in transportation and matching the types of crude to the appropriate refinery. But the supply is governed and controlled by cartel behavior. Ordinarily, that would be collusion, which would be illegal under US law. The cartel supplies about 30% of the day's world crude market, and their actions, either adding to supply or taking away from supply, will drive the price up or down. It's not really the last producer in the Bakken. And so if we look at it with the world market, it's a network. And this is a very simplified network. It's a nodal network. You can add something to A, it comes out at B. Add something to C, it'll impact B. And this next slide is perhaps the logical extension of this. This is from the BP presentation this year. What's interesting to note here is the US over the last several years has added almost 7 to 8 million barrels a day to the world market. About 3 million of this was added because of conservation. When the price of oil hit $147 a barrel in the summer of 2008, people gave up their pickup trucks and SUVs and began buying inexpensive, cheaper, high mileage automobiles. And they did this in a gold rush type of frenzy. That plus, of course, the CAFE standards have been increased. So the US has added supply to the world market in that way, and we now have added about 5 million barrels a day from the shale plays. The Brent market has been in decline. Its production's off about 2 to 3 million barrels from its peak. And I'm always confused by the folks who say that we want to get Brent pricing in Wyoming and Denver and the Bakken, and so you see all the producers arguing that they need to have the ability to export their crude. It just doesn't make any sense. The Brent market today, the marginal barrel comes in from Saudi Arabia, so they have to pay the Saudi price plus transport to get there. In this latest downturn of price, there are two primary reasons. The first is the Fed announced in the summer of 2013 that it would end quantitative easing. In that week, the rupee lost 11% of value against the US dollar. And later that week, Saudi Arabia began discounting crude oil to India and began discounting crude oil to other Asian economies. These are the Saudis and OPEC's best customers. And so the price of oil worldwide in some markets began to fall at that point. Here, it was still well over $100 a barrel. There, it began to inch downward. A recession in the Asian economies would not have helped OPEC. It wouldn't have helped anyone. I mean, we've gone from an 80 million barrel a day market in 2008 to a daily market of 94 plus million barrels today. World supplies increase more than world demand. China's growth last year was only 7.3%. I know that sounds like a huge drop, but that's kind of like going from 85 miles an hour down to 75 miles an hour. There's still growth. There's still tremendous growth. And these are the two reasons the price has fallen. Today, it's WTI is being purchased by planes for less than $60 a barrel in Cushing. So let's look at the influence of the US dollar here. A currency is a unit of account. It's a store of value. And of course, it's a medium of exchange. And at various points, the US dollar performs all three of those functions. But it is the unit of account and the medium of exchange for crude oil worldwide. And we can see that since 9/11, which is about when this slide begins, through to the end of 2012, the value of the dollar fell by more than 30% against other currencies. And then the Fed began to go away from quantitative easing. We began to see a bump up in value of the dollar. And now, when the Fed ended quantitative easing in the middle of 2014, we've seen a huge increase in the value of the dollar. Well, that means, of course, that oil became 20 to 30% more expensive for everybody else across the world. OPEC began discounting the price of crude even further because you don't need your best customers going into a recession. And a 30% increase in the price of crude is exactly what was going to happen with the value of the dollar going up. Now, a lot of folks have argued that having this low price will cripple OPEC because they won't be able to balance their budgets. And they say, well, you need $100 a barrel to balance the Iran budget. You need 120 a barrel to balance the Iraqi budget. You know, the Saudis need 120. But that's ridiculous because they deal in their own currencies. So the first thing that Russia did was devalue the ruble against the US dollar. And so the ruble's now trading at what, 50 to 30% of the value of the US dollar. So domestically, for their same production, which is about 10 million barrels a day, they're getting, of course, less money in terms of dollars, but they don't buy a lot of things that are dollar denominated. They stay in a domestic environment buying and selling in rubles. So they really haven't been hurt. Some members of OPEC have been hurt because they buy a lot of things in US dollars, but then if they had a huge store of foreign reserves, they've also become 20 to 30% wealthier because the value of their bank accounts just went up. Or the values of their stocks and their holdings on the US and world stock exchanges have gone up. So what sort of benefits do we have? The US dollar has made its big move, and we have had massive economic benefits to the US. We've cut net imports by about almost 5 million barrels a day, and this has led to a gain in GDP of almost $200 billion a year. It's a heck of a boost to an economy that was coming out of the recession in 2008. So how can we protect these benefits? Let's do a little economics. So we're going to get into the price elasticity of demand. It's defined as the ratio of the percentage change in quantity demanded to the percentage change in price. And since we're vulnerable to supply interruptions, we could see the quantity supplied to the world drop tremendously. This was part of our analysis with Rand. And so we estimated that a shock of 10 million barrels a day, an interruption, coming off of a 90 million barrel a day market and starting at $100 a barrel price, we would wind up with a shock price of crude oil of almost $400 a barrel. Other demand elasticities indicate different prices, maybe as much as $200 a barrel, maybe even higher. The Nordhaus number could get us to over $800 a barrel. That's pretty significant. And the way I explain this to numerous groups is when you get to a situation where You filled up your gasoline tank with 15 gallons. The value of that 16th gallon goes to zero in a hurry. But if you're short the 15 gallons, the value of that first gallon goes up in a hurry. You need it. And that's what we're looking at here. And we see this type of interruption causing a tremendous challenge to the US economy and to the world economy. Bumping prices up about $400 a barrel certainly wouldn't hurt too many producers, but it would hurt the consumers. And of course, there'd be more windfall profits, taxes, discussions, and all sorts of other things. We've given this paper in a number of different venues, and the only critique we get is that our estimation that it would come back in about 6 months is just too short, that the price interruption would continue and be certainly much more disruptive than we anticipate. In the interest of symmetry, though, let's suppose that there's a supply increase. And I began talking about this a couple of years ago. And suppose we got to the situation where we had an additional 1 million barrels a day get to the market. This could get us to maybe a shock price of $16 a barrel, or in our case, $68.75 a barrel. And when I presented this analysis at the University of Houston on September 30, this is about where we were. The IEA and the EIA had both come out and said the increase in supply that was unanticipated in September was about 900,000 barrels a day, or about 1%. And of course, if you extend this to December, when OPEC stood up and said, well, we think it's about 2% increased supply that we haven't really anticipated, or about 2 million barrels a day. Using the number of minus 0.04, a 2% increase in quantity would lead to a 50% decrease in price. And, son of a gun, that's exactly where we were. We got down into the 40s pretty easily. And so the decomposition of the price decrease in the crude oil markets comes about, one, because of the increased value of the dollar and the discounting that Saudi Arabia and OPEC did to keep their best customers level, at least level. And then second, the increased supply that came online because nobody really anticipated it. That was been about 1 million barrels a day that came out of the United States over this past year, and then 1 million barrels combined coming from Libya, Iran, Russia, and Iraq. And so an additional 2 million barrels hit the market that essentially nobody really anticipated, or nobody anticipated that it wouldn't be met by continued increase in demand. This is where we are today. OPEC announced and IEA announced yesterday that demand has increased by about 1 or 2% this year, and so prices have increased somewhat. But where does this work with shale crude? And in our prior company, we had a huge position in the Denver-Julesburg Basin, the 4th largest position in the Niobrara Shale, so we were very interested, of course, in break-even prices. This is from a couple of years ago, and these are the average marginal cost per barrel numbers. And so the Niobrara looking pretty good at $51 a barrel. The Mississippi Lime at 52. Every engineer tells me that's an optimistic price, but this is from Morgan Stanley. You can't argue with him. The Bakken at 64, Permian at 63, the Eagle Ford at 66. And so today, Plains is offering under $50 a barrel for Colorado oil and $50.35 for Wyoming sweet. And here's a chart that shows these break-even prices from a Bernstein report. This is a price required for a 10% after-tax rate of return, and assumes a 20% cost savings, and I'm sorry, that's from Tudor Pickering. And you can see they've got it mapped out here to the Mississippi shale coming in at about $70 a barrel. Well, not many oil and gas producers are going to be drilling just to get a 10% after-tax rate of return. And so we've seen that. We've seen the effect of the low prices. Over half the number of rigs operating are gone right now. So we've had a rig cut of over 1,000. We've had over 125,000 workers laid off directly in the oil patch. And of course, the impact is far and wide, as everyone here well knows. And then here's another measure. This is from Bloomberg, an analysis of some of the shale plays, and basically pointing out that many of these are unprofitable at $75 a barrel, and that what's offered at West Texas and Cushing is not what people get at the wellhead. So there's about a $10 delta between Cushing right now and Wyoming on the crude. And again, here's a marginal cost curve from, in this case, Bernstein, showing that some of the producers are better situated than others, but that on average, a price below 80 bucks a barrel really hurts. And we're beginning to see, of course, pullbacks in production from the shale plays. Now, this was not unanticipated in 2006. This paper by economic geologist here in the Colorado School of Mines and in Brazil and in Mexico pointed out the different thresholds for bringing different grades of crude and formations online, and in particular looking at the shale plays as becoming profitable somewhere around $40 a barrel. Now, as Lloyd mentioned, I do this for a living, or at least I hope to. And so one of the things that we did when we exited the Niobrara play, making our partners lots of money, was we went down to Texas looking for old-fashioned conventional reservoirs and resources, and we have one. And one that was drilled in 1984 and logged 54 feet of pay. And my partners and I and geologists who are up here are looking at this as, wow, everybody went to the shale side of the boat. And there are a number of conventional targets and reservoirs and opportunities across the United States that folks have just completely dismissed and forgotten about. And one of the great finds in the last 3 years is the Kern County field in California, which of course has been supplying crude oil for over 100 years. Now they've drilled a little deeper and they found, my goodness, there's a bigger pool of oil there. Anyway, so apart from that commercial, how is the price of oil set? OPEC follows the Nash-Cournot theorem. John Nash, the great economist of a beautiful mind, was tragically killed in that automobile accident last week or 2 weeks ago. They do these things in a cooperative, non-cooperative manner, and so it's not a zero-sum game for OPEC. They can band together, and they are the swing producer. I know a lot of folks have said the United States is now the new swing producer. But the idea of having 3,000 producers coordinate activity to raise price or lower price or raise production or lower production, that's just ridiculous. But these guys can do it. And so what they do is they estimate what works for the rest of the world, what the rest of the world will produce, and then they work backwards and then determine what sort of production level they want to have. And so for the last several years, that's been around 33 million barrels a day. And what they saw and what we forecast and what we foretold 2 years ago was that if they were going to begin to lose market share, they might, and the quote is this, it was in Forbes, they might begin to exert a little bit of market discipline upon producers who are high cost. And that article was why America's shale boom may soon be over. And that's exactly what's happened. OPEC didn't change what they were going to produce. They told everybody up front, we're going to produce 33 million barrels a day. They did. And the rest of the world outran the supply and drove the price down. And there's nothing more ridiculous than watching the CEO of a large independent in the US complain and ask for the Saudis to lower their production to bail him out of his bank covenants. Let's take a look at the world gas market. This is a little different. It's a network, but we really don't have much in the way of transport yet to really connect the United States to this network. The price of natural gas worldwide generally trades at its BTU equivalent for crude oil. So if the price of crude is 60 bucks a barrel, the price of natural gas should be somewhere close to $10 an MMBTU. Natural gas is used as a substitute in many economies, but not really much in the United States. It's used as a substitute for crude. For example, how many natural gas vehicles are there in the United States? Any ideas? Jim knows. Zero? No. We even have some in Houston. It's a little under, it's under 200,000. Under 200,000. We now have a third natural gas fueling station in Houston that I can find. That doesn't help me getting to Dallas, though. And there's a fleet actually of natural gas vehicles still in Oklahoma City. Thank you, Chesapeake. But in Pakistan, there are more than 1 million natural gas fueled vehicles. And in Brazil, there are more than 1 million natural gas fueled vehicles. Eventually, we may get there. Shell's looking to deploy natural gas to truck stops all across the US. And some of the rail lines are looking to bring natural gas in because, of course, you can put a large natural gas tank on your train and not have too many issues. Shale gas in the US, of course, dates from the 19th century, and folks used it for town gas. You know, with George Mitchell's pioneering work and many years of labor, he was able to unlock it and made vertical wells in the Barnett Shale very economic to drill. But of course, that was when the gas price was significantly higher than it is now. And we have seen the price of natural gas, at least in the Utica and the Marcellus over this winter, drop to 70 cents an MCF at the wellhead. And by the way, in the Barnett, there are no rigs turning right now in the dry gas window of the Barnett. There haven't been any in 3 years in Johnson County. This is somewhat similar to what I just read about with Montana. There are no rigs turning in Montana right now in the Bakken. We did an analysis back in 2012 looking at the arithmetic of shale gas. And of course, the EPA has just come out and said, well, there really are no instances of fracking and shale gas development contaminating water. Well, there was no evidence 4 years ago. There's been no evidence for the last 40 years that this happened, except in some very, very rare circumstances, and most of those having to deal with casing failures. We did an analysis saying, well, you know, prior to the shale boom, the price of natural gas was quite significant. It was about $8 an MCF, and of course we remember it at 11 and 12 before that. But let's just date it to 2008, when the wellhead price was about $8, and then in 2011 the wellhead price was below $4. The gain to the economy has been about $100 billion a year, a $100 billion gain to US consumers because of this. This is really quite extraordinary. It's led to new plant construction of more than $200 billion in the Rust Belt. Pennsylvania, New Jersey, Indiana, Ohio, places where industry left town a long time ago. These plants are going to provide more than $200 billion of new gross domestic product. It's actually allowed us to begin exporting plastic goods, glass, and other products made with natural gas to China. So a little turnabout. The ships come over here fully laden, they go back fully laden. And here are the economics of shale producers in natural gas, and most of them are somewhere effective here at the $3 to $5 an MCF level. Right now, I think natural gas is a little below $3. So it's not an easy time for shale gas producers either. One of the things we think about is what sort of economic substitutes do we have? And we don't have many. For there to be a real economic substitute, it has to be priced competitively at the pump. It has to be delivered seamlessly to the consumer. We try not to have it subsidized by the federal government. And it has to be commercial in some sort of amount of time. In Houston, I can do this talk, and somebody's got an electric car. Does anybody here have a hybrid or an electric car? We've got 1, 2. That's outstanding. 3. Very good. This is your around town car. This is not one you take to drive to Casper or Cody, is it? It's not one I'd take to drive to Dallas or San Antonio. But if I could plug it in and work it and not have the grid blow up, that would work pretty well for me. But one of the challenges of the grid providers, at least in Houston, have ascertained, if every other car in town became an electric and you had to charge it, that would really interfere with the cycles on the transformers at night. So I want to talk now about energy security. And I want to go back to a time when the United States actually had an effective energy policy. And so in 1956, President Eisenhower was enjoying the post-war era, and Great Britain and France joined with Israel and invaded the Sinai Peninsula to retake the Suez Canal that Nasser had nationalized. The argument that they gave to Eisenhower the next day was that 80% of Europe's crude passed through the Suez Canal. Today, less than 4 million barrels a day passes through the Suez Canal, and nobody really cares. And Eisenhower realized, well, hell, you can just take it around Africa and come back up. It'll just take you another 20 days. But Eisenhower knew the strategic value of oil. He'd spent most of World War II trying to get oil supplies and prevent the other guys from getting theirs. His response to Great Britain and France is, of course, one of legend. This is the direct quote. He did not want the US to be dragged into a conflict in the Middle East. He didn't care who owned the canal. He didn't care who owned the oil. He had no idea how this would work out. He just didn't want to be there strategically and militarily. Greenspan, the great economics advisor during the Ford era, and then later the chairman of the chairman of the Fed, pointed out that everything in the Middle East, and especially with the Iraq War, is all about oil. Everything in the Middle East. And so what is the cost of war? Prior to the operation that we went in Iraq in 2002, Nordhaus estimated that it would cost us $1.6 trillion. Stiglitz, the Nobel Prize winner, and his co-author estimated on the 10th anniversary of 9/11 that the cost had been $3.4 trillion. That update with the cost of war project at Brown University now is up to $4.4 trillion. Or that's about $50 a barrel for every barrel the United States has consumed since 9/11. That's about $1.20 at the pump. Now, we don't want to get too political on this, but how long would the electorate have allowed us to stay in the Middle East with this type of expenditure going on? And we've had this discussion, I've had this discussion with proponents and opponents of the Keystone Pipeline, which would bring about 750,000 barrels a day into the United States from Canada. They argue, of course, that the environmental issues and dangers and the spills and the cleanups, well, there's 71 pipelines that cross the border between US and Canada today. And, if you look at it, and you look at the 4.4 trillion, and then you take a look at what the Department of Defense updates every day, with over 6,000 dead and almost 60,000 wounded from our activities in the Middle East, that's probably 300,000 families, and we all know somebody. And I'll bet they would gladly trade 6 months cleaning up a pipeline spill somewhere for where they are right now. So in 1959, Eisenhower looking ahead, did not like the idea of us getting embroiled in the Middle East, and he imposed an import quota on oil, limiting oil to 12%, imported crude to 12% of domestic production. OPEC formed in response in 1960 and immediately began reducing production so that they could raise the price, because when Eisenhower cut off imports beyond that certain level, the price of crude worldwide fell. And what did happen was the price of crude from 1959 to 1974 in the United States was controlled by the one swing producer we all know, the Texas Railroad Commission. And the price of crude was roughly double the world price over that period of time. It wasn't until 1974 when Eisenhower's vice president, Richard Nixon, eliminated the crude oil import, thinking he would have access to cheaper crude from abroad. That didn't turn out very well because, of course, then we had the embargo and the prices went up. But we've proposed going back to this import quota, cutting our reliance upon imports from folks who control the world market. We would insulate the U.S. market. We could run prices back up to 100, 120 bucks a barrel. That would, of course, be a boon for producers. It would encourage the development of alternative uses, of alternative transportation modes. Maybe we'd all have hybrids and electric vehicles. We would do this over a period of 9 or 10 years, gradually reducing our reliance upon imports and raising the domestic price. This would get us to a level of independence and energy security so that no matter what happened in the Strait of Hormuz, the United States economy would continue to develop and thrive and not have too many challenges from having to deal with a capricious cartel. And there are resources and sites here which are part of the presentation as well. So I'll be happy to take any questions and comments and criticisms.
Question from the board, please.
Great presentation. I think I recall last time when you spoke, you were prognosticating on when the Keystone Pipeline would get built. And what's your thoughts on that now?
You know, I don't understand why TransCanada doesn't just send out a group of landmen and get a permit and right-of-way that just excludes Nebraska completely. And we just eliminate the discussions with Nebraska. Since that time, we had a big ceremony in Houston where Enbridge and Enterprise opened Seaway 2 or Seaway Twin, which is bringing 200,000 barrels a day down. Many pipeline companies and, of course, the rails have already supplanted that 750,000 barrels a day that Keystone would bring. Keystone just became the football, the bogey that the environmentalists went after, that the rail guys went after, that the administration went after, that the industry went after. I don't know if it will ever get built.
Thanks.
Yes, sir.
Hang on and I'll bring you a mic.
Oh, yeah.
Coming at you.
I want to ask you a question about OPEC. I mean, noticeably, OPEC market share is eroding because of the non-OPEC supply coming into the market. And yet oil markets have been largely determined by, as you point out, maximizer profitability, hotelling's theory, et cetera, et cetera. What's your view about the future of OPEC, and is it likely to change that strategy in view of its eroding market share?
Yeah, I don't think OPEC's going to be able to change its market strategy right now. They don't have any other industry in those nations. They don't have any access to hard currencies. They don't have any access to manufacturing, tech development. Their livelihoods are tied to the production of oil and natural gas. They have to start thinking about what the future is going to look like if and when the world becomes less dependent upon carbon fuels. No one knows the extent of reserves that Russia has. When you get a couple hundred miles east of Moscow all the way to the Pacific, that area really has not been explored geologically. China is just now beginning to get a grip on its vast resources and is working diligently to figure out how to get the technology in. It's entirely likely that OPEC will become less of a factor as other nations bring their supplies online. The west coast of Africa, for example, the growth there since the Jubilee field was founded with Cosmos, millions of barrels a day brought to the market just from new technology, new development, and looking at an area that was previously untapped. And that, of course, has lessened the involvement of OPEC, but still at 30 million barrels a day, 33 on a 94 million barrel a day market. Certainly they control the economics for the rest of us. No one in this most recent downturn volunteered to step up and cut production. Certainly the Russians could have done that, but we didn't see anybody step forward that way. Other questions? Yes?
Ed, as usual, wonderful, insightful, and thought-provoking presentation. Two questions. Yesterday, we had a presentation associated with coal exports and the relative dependence or expectation that a number of large countries, China, India, et cetera, would be consuming significant quantities of coal over the long term. You just mentioned the situation in China with respect to their potential reserves, both of oil and I suspect in natural gas, and I was curious if you could share with us from a Houston perspective, from an oil and gas perspective, how you see that market developing, when you see it developing, and whether they will import LNG in the near term or long term. That's number one. Two, you've had a number of quotes about previous presidents seizing on the worldwide oil market, but having followed a bunch of this, I've been perplexed why our government hasn't responded in a different way. Namely, where has the Congress been? And I'm asking from a Houston perspective. Is it because they don't understand? They don't care? What?
Okay. First question. Asia is going to be a big importer of LNG. I don't know how much of it will be from the U.S., but we've got 4 or 5 plants that will be online in the next several years. I don't know that I would want to be involved in the 15th or 16th or 17th exporting plant, which will come online in 7 or 8 or 9 years. That may be too late to really take advantage of this market. Australia, of course, Malaysia, Indonesia are looking to supply a lot of gas into mainland Asia. The Chinese have hundreds of thousands of square miles of shale that apparently are very gas rich. We met with a number of their companies over the last 4 or 5 years as they've worked to develop and obtain the technology necessary to go drill and harvest that. And they're in a position where they don't have that infrastructure in place yet. They don't have the pipeline infrastructure in place. But China can act in its own national interest in a big way. And so if the government in Beijing decides this is something they want to do, they will get it done. And the rest of us will not be supplying much gas to them. India and Pakistan may be entirely different. Their geology is different. It remains to be seen. It's a huge nation. It's a huge group of consumers. It's got fabulous natural resources. It's just a question of how quickly, how rapidly they can get the technology and then the manpower to go deploy and harvest that resource. And I think keeping in mind that they will be consuming most of it themselves. The second question is, where are the political leaders? Well, Eisenhower, when he issued the executive order in 1959, this was not very popular. But he was also General Eisenhower, and there was no one of any stature who could really argue with him. We've taken our recommendations to Congressman Olson. We've taken them to Congressman Culberson, Senator Cornyn. We had them in front of Dingell. We had them in front of Waxman. Secretary Chu. Nobody wants to do anything that would raise the price of fuel at the pump. And of course, our policy would do that. They'd much rather spend $50 a barrel for every barrel we burn, extending a defense umbrella to people who may not like us anyway. I mean, we don't know which side of the conflict in Iran and with ISIS and Saudi Arabia and Syria we're on from day to day. We're fighting with somebody over here against somebody over there. You know, this is, you know, at least with a baseball game, you've got uniforms and you know whose side you're on. And here they change from hour to hour. And you know, Iraq was our ally, then they weren't, then they aren't, now they are. And so this is really difficult. And these are hard decisions that no politician in Washington wants to make. No politician in Houston wants to make it. Nobody wants to do anything that would show up at the pump. And so instead, all of our conflicts in the Middle East go on our national MasterCard. And that's about $4.4 trillion of new debt that eventually will repudiate some way when we devalue the dollar. But you know, it's not showing up where the electorate could actually understand what's happening.
Any other questions? Well, Ed, thanks for your time and your travel to Wyoming. You're always welcome here, and let's give Ed a hand, please.
Lloyd. Thank you, Lloyd. This has been absolutely fabulous, and I really appreciate your work, and I'm sure everyone here does. I've heard nothing but good things, and everybody's absolutely right. Once you get into Lloyd's sphere, you stay there. Thank you.